Hi everyone and welcome to today's video. In today's video I'm going to tell you about the top investing mistakes that beginners make and how you can avoid them. So that's all coming up in today's video. Don't forget to give this video a like now, it really helps out the channel. Thanks for liking the video, I really appreciate it. Also don't forget to subscribe if you want to see more videos from me. All you need to do is click subscribe below the video. Thanks for liking and subscribing. Now let's get into it. I've got 5 investing mistakes to tell you about today. These are investing mistakes that beginners tend to make, but also I've seen seasoned investors even make these mistakes as well. I've made some of them myself, so I want to tell you about them today so that you can avoid them, so that you don't make these mistakes yourself. So stay tuned for all 5 of them because there's definitely something to learn for everyone. Number 1 is not investing sooner or putting off investing. So for this one, the best thing to do is just get invested right now. There is no better time to start investing than right now. Yes, you could have started sooner, but that is no reason not to start investing now. Don't try to time the market. You could leave investing even longer and then you will regret not starting right now. Because the longer you invest for, the longer your money has time to grow, and that is the power and the beauty of compound interest. So the best thing that you can do is to start dollar cost averaging into the market. So that just means that you invest every month, whether the market is up or down, you don't look at it, you don't care, all you do is invest every month and you dollar cost average into the market. You can set up your investments monthly so that you're dollar cost averaging into the market. You're not concerned whether the market's gone up or down, you're just investing on a monthly basis. Because after all, it's been shown that if you try to time the market, then you end up missing out on the best days in the market. The best way to avoid mistake number 1 is just to invest right now. If you are able to do so, then there's no reason to not do it today. If you've been putting it off, there's no better time to start than right now. Because the sooner you get your money into the market, the sooner you can start earning the compound interest that you need. So get started investing, especially if you have been putting it off, you've been thinking about it for a while and you have the means to do so. It's definitely the best time to invest because the best time for you to get started investing is today. And don't worry that you didn't get started sooner because the best thing is that you are getting started right now. The second beginner investing mistake to avoid is not investing because you only have a small amount to invest. So this is linked to number 1, and this is to do with thinking that you shouldn't invest your money because you only have a small amount to invest each month. Let me tell you why you should definitely invest even if you only have a small amount to invest each month. This reluctance to invest with only a small amount each month is linked to the idea that investing is only for the rich and that it's expensive to invest, so therefore you shouldn't do it. But the truth is that investing can be inexpensive and it's definitely not just for the rich. In fact, this is the way that the rich get rich. So it's definitely not something that you should discount because you don't think that it should apply to you or you don't think that you can do it yourself. You definitely can. Fees can be inexpensive, you do have to shop around for low fees, but you definitely can invest with a small amount each month and you can get low fees and it's definitely not just for the rich. Plus, whilst you do have to pay some small fees to invest, these are vastly outweighed by the gains that can be made by investing. So don't be put off investing if you only have a small amount to invest because that small amount will grow to a much larger amount if you invest it. Let's take an example of a monthly investment and I'll show you how over 30 years it can grow. This example does use a monthly investment amount of £100. If £50 or £25 is what's more achievable for you, then you can just halve or quarter this amount to get the figures that are suitable for you. This is just an example to show you how much you can get after 30 years if you're investing £100 a month. If you invest £100 a month for 30 years, then assuming an average return of 10%, you can expect your investment to grow to £230,000 in that 30-year time span. This is with you actually only contributing £36,000 and the rest of this is compound interest. So you can see that the majority of that money, almost £200,000, is compound interest. So it just goes to show you that what might be considered a small investment amount each month can grow to a much larger sum over time. Now, as I said before, if £50, £25 is more feasible for you, then just half or quarter that amount. But it does just show you that your money really can grow over time with investing, and it doesn't have to be a large amount each month that you put aside. I hope that showed you that you can and that you should invest even if you only have a small amount to put away each month. Number 3 is not learning for yourself. I think there's so much power in learning to invest for yourself so that you don't have to rely on someone else to do your investing for you. It is your money after all, so I think you should be empowered to invest it for yourself. There are so many free resources out there that you can use to learn how to invest yourself. There are so many resources out there for you to learn from, in particular YouTube. I think YouTube is a great way to learn about investing. There are tons of YouTubers that make great investing videos. You're watching an investing video right now, and there are lots more out there. I think it's a really great place to learn about investing. Also, you can check out books. There are so many great investing books. I've linked my favourite investing books down below in the description. I think they're a great way to learn because you can learn about things in detail and you can always come back to them if you have a question or you want to check back on something in the future. They're really good, so I've listed my favourites down below. Also, I love podcasts as well. Podcasts can be a great way to learn a little bit more about different topics. And you can also check out websites. If you have any questions, just put them into Google. Or Hargreaves Lansdown has a website where they break down, they have a top 50 fund shortlist, which is really helpful. They have loads of resources on there. It's all free. You don't have to have HR as your investing platform to use their resources. I found them really helpful when I was learning to invest because they break it down really simply and they give you lots of good information on there as well. So I'll link that down below for you to check out too. Those are just a selection of the resources that you can find online, but of course you just need to decide what's best for you and how you want to learn. But it can be really simple, like lots of these resources break it down so simply, especially on YouTube. You can watch some videos that break it down really simply for beginners, and you can use these to learn some more, and then you won't have to rely on spending your money to get someone to invest for you. If you want to pay for the convenience then at some point in the future, then of course you can, but at least you will know what you want to invest in and you'll be empowered in that way, so you won't be invested into something that you don't know about or you're not interested in. There's nothing stopping you from choosing a ready-made portfolio, and I think that's great for lots of people. I'm just saying that it's really important that you know what you're investing in. Number 4 is paying high fees. So this is another beginner investing mistake to avoid, and it's linked to number 3. When you start investing, I know it can be daunting and it can be hard to get your head around what the fees even are, and also of course to find out what is a high fee and what is a low fee. There is so much to learn at the beginning, but this is just something for beginners to watch out for because it can cost you a lot of money in the long run. That's why it's important to learn about and figure out what the fees are when you're investing. Here are 3 fees you can expect to pay. These are a platform fee, a fund charge, and a trading fee. A platform fee is the fee that you will pay to your investment platform. A fund charge is a charge that you will pay to the fund when you invest in that fund. And a trading fee is a fee that you pay to buy and sell stocks and funds. This could be a whole video in itself, but the point here is just to check what these fees are and shop around for the lowest ones available. Watch out for fund charges in particular, because if you're investing in actively managed funds, then your fund charges will tend to be much higher, but it's actually been shown that actively managed funds don't tend to perform any better than passive index funds, and passive index funds do have much lower fees. So it's definitely something to look out for if you are investing in funds. Number 5 is having a high percentage of bonds in your portfolio. So this is not investment advice, but if you do have a long investment time horizon, then you should be investing in a higher percentage of stocks versus bonds. This is because your money has a longer time to grow in the market. If you do have a long investment time horizon, then bonds should not make up a high percentage of your portfolio. They are seen as safe investments, but low risk here does mean low reward, and you will not get rich by investing in bonds. If you are many years away from retirement, then your investment portfolio should not heavily feature bonds. The rule of 110 is a way that investors can decide how much of their portfolio should be allocated to stocks. You just do the calculation 110 minus your age, and that gives you the percentage of your portfolio that should be in stocks. So for example, if you're age 30, then you do 110 take away 30, and that would tell you that 80% of your portfolio should be invested in stocks. So that would tell you that 80% of your portfolio should be invested in stocks and the rest would be in bonds. If you have a higher risk tolerance, then you might use the rule of 120, and if you follow the rule of 120 and you're 30 years old, then you would invest 90% of your portfolio into stocks. I use the rule of 120, but you can decide what's best for you, and it all depends on your investment timeline. That's it for today's video. Those were 5 beginner investing mistakes and what you can do to avoid them. I hope you enjoyed the video. Thank you for watching to this point. If you have watched to this point, don't forget to like the video. Thanks for liking the video. Also, if you want to stick around and see more videos from me, then be sure to subscribe. All you need to do is click the button down below the video. Thank you for watching and see you next time.